Welcome to this deep dive. We're taking the latest earnings calls, cutting through the jargon, really getting to the core investment story. Today, it's all about leveraged finance, specifically Carlyle Secured Lending, CGBD, after their Q2 2025 results came out.
Yeah, it's a really interesting one because, the market reaction wasn't quite what you might expect, maybe not what management expected. CGBD actually delivered a record performance in terms of deployment growth.
Yeah.
But the stock, it's really lagged the indices this year.
Big time.
Right. So our mission today is pretty clear. Synthesize these Q2 numbers, figure why the market's maybe giving CGBD the cold shoulder, and try to pinpoint what catalyst might actually turn this thing around in the second half of the year.
Okay, let's start with the top line, the headline financials. At first glance, they looked fine. Pretty decent, actually.
Yeah, net investment income, NII, that's the core profit for a BDC, right? It came in per share at 39 cents.
Exactly.
Meeting the consensus estimate. Spot on. And total investment income, think revenue, was $45.55 million. That was a slight beat, about 1.7%, and a pretty solid 9.4% increase year over year. So far, so good.
And crucially, the dividend. Management declared a Q3 dividend of $30.40 per share. So stability there, they're holding the line.
But, and here's where the friction starts, the bid investors really latched onto. While the NII coverage was tight, 39 cents earned versus 40 cents paid out, the bigger issue was the net asset value, the NAV.
The value of the underlying loans. It slipped.
Exactly. NAV per share dropped sequentially to $16.43. That's a 1.2% decline. And look, for a BDC, NAV is probably the clearest signal of portfolio health. A drop like that, quarter over quarter, it just suggests some stress.
So the market saw that NAV dip and got nervous.
Pretty much. The day after the earnings came out, the stock saw a modest dip, but it was noticeable. It signaled investors wanted stability, not more erosion, especially right after they just closed a big merger.
Okay, so that's the core tension, because operationally, like you said, management probably felt they had a good story. Justin Plouffe, the CEO, was talking execution deployment. And the numbers, they seem to back that up. Just how big was that deployment volume?
Oh, it was massive. The whole Carlyle direct lending platform had a record quarter. They funded $2 billion in new originations. Just huge.
Wow, $2 billion.
Yeah. And for CGBD specifically, the BDC, they funded $376 million of that. They made a point of saying it was their highest level since the IPO back in 2017. So net investment activity was $238 million, and that pushed their total portfolio up to around $2.3 billion. That's real growth, serious velocity.
Okay, record deals flying out the door, strong sourcing feels confident, but at the same time, NAV is under pressure. That feels contradictory. What did the CFO, Tom Hannon, say was driving that 1.2% NAV slip? Was it broad market stuff or specific problems in their book?
He was pretty specific, actually. Gave two key points. First, remember, Q2 was the first full quarter with the CSL III merger integrated. He made sure to say the merger didn't change the underlying earnings power. So that wasn't the drag.
Okay, understood. So if the merger wasn't the problem, what nicked the NAV by 1.2%?
Right, so the decline came down to an aggregate loss, realized and unrealized, of about $14 million. Works out to roughly 19 cents per share. And management broke it down like this. They said 60 to 65% of that loss was, quote, idiosyncratic, company-specific credit marks.
Meaning specific loans went sour, not the whole market tanking.
Exactly. It wasn't a macro shock hitting everyone. It was specific borrowers struggling. They basically marked down some, let's call them bad apples in the portfolio.
But wait, didn't they also talk about fixing a problem loan? This Maverick company? They cleaned it up quickly right after the quarter ended and got non-accruals back down?
They did. Non-accruals had increased during Q2, hitting 2.1% of fair value. But then, right at the start of July, they restructured Maverick, and boom, the pro forma non-accrual rate dropped immediately back down to 1%.
Okay, so they're good at cleaning up messes.
Right.
But if non-accruals spiked to 2.1% first, does that maybe hint that the quality of the loans they're putting on the books initially is slipping a bit, even if the workout team is great? Are they maybe growing too fast?
That is the million-dollar question, isn't it? Management's angle is, the Maverick fix shows they're proactive, disciplined, they can handle workouts. They're essentially saying, yeah, we had a blip, some stress, but look how fast we dealt with it. It shows the platform works, sourcing and managing, but it absolutely confirms that in this market, which is super competitive, you need constant, aggressive credit management. Quality is key.
And that focus on quality seems okay structurally, right?
Yeah.
Portfolio looked pretty sound on paper. Diversified, what was it? 202 investments, 148 companies, 25 plus industries.
Yeah. broad diversification. And sticking to the BDC playbook, 94% of those investments are senior secured loans, top of the capital structure.
And what about leverage? Do they have room to make more deals?
They do. They've got statutory leverage at 1.1x. That's right in the middle of their target range. So, yeah, plenty of dry powder, flexibility to jump on deals when or maybe if the M&A market finally picks up later this year.
Okay, let's shift to that bigger picture, the investor context. Even with this, operational strength and decent positioning, the whole sector faces headwinds. What macro themes did management emphasize?
Well, the big immediate one is spread compression, pricing. Management basically confirmed that private credit spreads are still, quote, historically tight, which means the profit margin on new deals, it's pretty skinny right now.
Right. Less profit per loan.
Exactly. And you combine that with the market expecting, or at least anticipating, potential Fed rate cuts.
Okay.
Well, that's a clear drag on NII in the near term. They don't think spreads will get back to those really wide 2023 levels, but they are betting on some normalization as deal activity hopefully increases.
And that deal activity, the volume they need to deploy all that capital, it really hinges on private equity M&A finally waking up, doesn't it? What do they say about the pipeline? Just hope or?
They guided for, the usual seasonal summer slowdown in Q3, kind of expected. But they did sound pretty optimistic about the pipeline rebuilding for a, quote, busier end of the year, Q4 and rolling into 2026. However, that optimism is completely tied to a real pickup in M&A volume from their PE sponsors. It's definitely a contingent bet.
Okay, so if the core lending faces headwinds, what about strategic growth? The JVs, joint ventures, seem like a big part of their story for boosting returns, right?
Absolutely. The existing one, the MMCF joint venture, is apparently hitting a mid-teens ROE run rate. That's pretty good. The plan there is to get all the current equity deployed in the next, say, 2 to 3 quarters.
But you're also looking at another one, a second JV.
Yeah, and that's maybe the more interesting long-term signal. They're actively exploring setting up a second strategic JV.
Why is that such a big deal? Especially if they said any benefit is probably a 2026 event.
Well, it's about structure and scale, really. They're looking to use their non-qualifying asset capacity. It's a regulatory bucket more effectively. Essentially, finding a more capital-efficient way to invest, leveraging the whole huge Carlyle global CRAT platform. It's a structural play to drive higher returns than typical BDC lending can deliver. It shows they're building for 2026, kind of accepting that 2025 might just be transitional.
And the new hire reinforces that long-term thinking, doesn't it? Bringing in Alex Chi.
Yes, definitely. Getting Alex Chi, who came from the Goldman Sachs BDC world, as deputy CIO and head of direct lending starting early 2026, that's a major signal.
Yeah.
It backs up their strategy. Focus hard on the core middle market, grow the platform, and bring in top talent to manage that growth through the next cycle.
Okay, so let's step back. The market seems stuck on the NAV slip, the tight spreads hurting near-term NII. Management, meanwhile, is talking record deployment and building for 2026. And the stock has just cratered relative to the market, right? Down like 26% year to date versus the S&P up, 14%? That gap is massive.
That gap is either the opportunity or it's the trap. Getting the stock re-rated, convincing investors to pay a better multiple, it really all hangs on that H2 M&A pickup actually happening and on getting that new JV capacity deployed efficiently down the road.
Right. So we've got this tension, credit worries now versus potential growth later. So if we were putting on our investing hats, how do we play this divergence? How do we translate this into a potential trade idea?
Okay, let's move into our This Is Not Financial Advice segment. The alpha hunt. And remember, everyone, this is purely educational, maybe a bit aggressive, but it's about finding that idiosyncratic value.
All right, lay it on us. How do we exploit the market seemingly ignoring the operational wins here?
Okay, the thesis is pretty straightforward. CGBD is trading cheap, significant discount, partly sector skepticism, partly that NAV markdown we discussed. But management have executed incredibly well on deployment. They show they can handle credit workouts like Maverick. And they have big cushion, right? They estimate about 89 cents per share in spillover income. That protects the 40-cent quarterly dividend for quite a while.
So dividend looks safe, deal engine is roaring, but the market's just not buying the timing yet.
Exactly. So this calls for a bet on execution, relative value, the pitch, a pair trade. You go long CGBD, and you fund it by going short a broader, maybe less actively managed BDC index, something like BIZD.
Okay, that's bold. You're essentially betting on PE M&A finally getting its act together, which feels like, it feels like the market's been waiting for that for 18 months.
It's a bet on volume returning, yes. but it's more specifically a bet on Carlyle's platform strength. This isn't just a rising tide lifts all boats macro bet. It's a bet that CGBD, specifically, with its proven origination engine, its clear path to JV growth, the new leadership coming in, that it will significantly outperform that sluggish peer basket when the Q4 M&A market finally unlocks. If management's right about H2 picking up, the alpha here, the CGBD-specific outperformance, could be substantial relative to a flat sector index.
Got it. High conviction, but hinges on Carlyle's sourcing staying strong. And yeah, the sponsors finally pulling the trigger in Q4. The stock is cheap. Management has delivered operationally. It really is a waiting game for those catalysts now.
It is. The stock's discounting the future. Management seems focused on building it.
Which brings us nicely to our wrap-up. This deep dive into Carlyle Secured Lending really highlights that tension. Management delivered record activity, kept the dividend steady. But those tight spreads, that little NAV dip, it was enough to keep market skepticism high and the stock price down. The short-term focus really punished it, creating that discount.
And the final, maybe provocative thought for you, the listener, to mull over is this. Given management's heavy emphasis on the core middle market, that commitment to underwriting discipline focusing on quality over just chasing yield in tight markets, how sensitive is CGBD really to maybe further unexpected Fed rate cuts if they happen before Q4 deal flow properly kicks in? We know tight spreads are a headwind now, but what's the immediate NII trade-off risk versus the potential long-term benefit of maybe avoiding more credit problems down the line? The market seems fixated on next quarter's NII, while management's eyes are clearly on 2026.
That's a great question to keep in mind as we watch that M&A pipeline. Thanks for joining us for this analysis. We hope this helps you continue your own learning journey. We'll catch you on the next deep dive.